A massive shift is happening in the global chip industry right now. While Nvidia dominates AI hardware across most of the world, something unexpected is unfolding in China. Homegrown Chinese chip makers are rapidly gaining ground. Companies like Huawei and Cambricon are filling a crucial market gap, and this development has enormous implications for global tech investors. Let me walk you through exactly what is happening and why it matters to your portfolio. First, let's understand the core issue. Nvidia has been effectively locked out of China's AI chip market. This is not because of business strategy or competitive weakness. It is due to US government export restrictions. Starting in 2022, Washington imposed strict controls on advanced semiconductor exports to China. The stated goal was to prevent military applications of cutting-edge AI technology. These restrictions specifically targeted Nvidia's most powerful chips. The A100 and H100 data center GPUs were banned from export. Nvidia tried to create modified versions that complied with the rules. They developed the A800 and H800 chips. But in late 2023, those workarounds were also blocked. The result is a massive market opportunity sitting empty in China. China represents roughly 1/3 of global semiconductor demand. Their AI infrastructure build-out is accelerating rapidly. Every major Chinese tech company needs advanced chips for AI training and inference. But they cannot access Nvidia's latest generation hardware. Nature abhors a vacuum, and so do markets. This is where domestic Chinese chip makers enter the picture. Huawei has emerged as the primary beneficiary of this situation. Their Ascend series of AI accelerators is gaining serious traction. The Ascend 910B chip is their flagship product. It is designed specifically to compete with Nvidia's restricted hardware. Now let's be clear about the technical reality here. Huawei's chips are not yet matching Nvidia's absolute top-tier performance. The Ascend 910B reportedly delivers performance comparable to Nvidia's A100. That puts it roughly one generation behind Nvidia's current H100 and upcoming B200 chips. But here's the critical point for investors to understand. In a market where the best option is unavailable, the second best option wins. Chinese companies do not have the luxury of waiting for Nvidia. They need to build AI infrastructure today. Huawei's Ascend chips are domestically available and increasingly capable. Major Chinese tech giants are adopting them at scale. ByteDance, the parent company of TikTok, is reportedly using Ascend chips. Baidu has integrated them into their AI cloud services. Alibaba and Tencent are also diversifying away from total Nvidia dependence. Beyond Huawei, other domestic players are rising. Cambricon Technologies specializes in AI chip design. They focus on inference chips rather than training accelerators. This is a smart, strategic position. Inference workloads require less cutting-edge performance than training. It is an easier market for domestic players to compete in. Cambricon's chips are being deployed in smart city, infrastructure, and edge computing applications. Another player worth noting is More Threads. They are building GPU alternatives for both AI and graphics workloads. Now let's zoom out and look at the bigger geopolitical picture. What we are witnessing is the fragmentation of the global semiconductor supply chain. For decades, the chip industry operated on a model of deep international integration. Design happened in the US, manufacturing in Taiwan and Korea, and assembly in China. This created efficiency, but also strategic vulnerability. Both the United States and China now view semiconductors as a national security priority. The US is using export controls as a tool of strategic competition. China is responding with massive investments in domestic semiconductor self-sufficiency. Beijing has poured tens of billions of dollars into chip development programs. The results are starting to show. China is not yet fully independent in advanced chip manufacturing. They still lag significantly in cutting-edge lithography equipment. TSMC and Samsung remain far ahead in process node technology. But China is closing the gap faster than many Western analysts expected. SMIC, China's leading foundry, is reportedly producing 7-nanometer chips. That is several generations behind TSMC's current 3-nanometer process. But it is sufficient for many AI and commercial applications. So what does all of this mean for you as an investor? Let me give you some practical guidelines. First, understand that the semiconductor industry is now bifurcating into two ecosystems. There will be a US-aligned ecosystem centered on Nvidia, AMD, Intel, and TSMC. and there will be a Chinese ecosystem centered on Huawei, SMIC, and domestic players. These two ecosystems will have limited overlap going forward. Second, recognize that Nvidia's total addressable market is effectively smaller than it appears. China's AI chip market could be worth $50 billion annually by 2030. Nvidia is largely excluded from capturing that revenue. This does not mean Nvidia is a bad investment. They still dominate the rest of the world. But investors need to factor in this geopolitical ceiling on growth. Third, consider the implications for Nvidia's competitors. AMD benefits from any Nvidia weakness or constraint. They face the same export restrictions, but they are gaining share in accessible markets. Intel is attempting a comeback in AI chips with their Gaudi accelerators. They are further behind, but they are also investing heavily. Fourth, think about the semiconductor equipment makers. Companies like ASML, Applied Materials, and Lam Research face complex dynamics. They are restricted from selling their most advanced tools to China, but China is still buying older generation equipment in large volumes. This creates a split revenue picture that investors need to analyze carefully. Fifth, watch the supply chain diversification trend. Companies are increasingly building redundant supply chains. This reduces efficiency, but increases resilience. It also creates opportunities in countries like India, Vietnam, and Mexico. For beginner investors, here's my core guidance. Do not try to pick individual winners in the Chinese domestic chip sector. Those companies are not easily accessible to US retail investors. Many are state-backed and carry significant regulatory and geopolitical risk. Instead, focus on understanding how this trend affects the US-listed companies you can actually invest in. If you own Nvidia, recognize that this is a long-term headwind. It does not invalidate the bull case, but it does add a risk factor. Consider diversifying across multiple semiconductor names rather than concentrating in one. Look at broad-based semiconductor ETFs as a way to gain exposure without single stock risk. The SOX ETF tracks the Philadelphia Semiconductor Index. It gives you exposure to the entire US chip ecosystem. Also, pay attention to companies that benefit from semiconductor nationalism. Domestic manufacturing and supply chain resilience are now policy priorities. Companies building fabs in the US and Europe may receive substantial government support. Finally, remember that geopolitics introduces non-economic risk into technology investing. Policy decisions can override market fundamentals. Export controls, tariffs, and sanctions can reshape industry dynamics overnight. This requires a different analytical framework than pure financial analysis. You need to follow policy developments as closely as earnings reports. Subscribe to geopolitical analysis sources, not just financial news. Understand the strategic objectives of both US and Chinese policymakers. The bottom line is this: China's domestic chip industry is advancing faster than many expected. Huawei and others are creating viable alternatives to Nvidia in the Chinese market. This represents a permanent structural change in the global semiconductor landscape. Investors who ignore this trend will be caught off guard. Those who understand it can position their portfolios accordingly. Before we wrap up, I need to give you the critical disclaimer. Nothing in this video constitutes financial advice or a recommendation to buy or sell any security. I am providing educational analysis of market trends and geopolitical developments. Every investor's situation is unique. You should conduct your own thorough research. Consult with a licensed financial advisor before making any investment decisions. Semiconductor stocks are volatile and carry significant risk. Geopolitical developments can create sudden and unpredictable price movements. Only invest money you can afford to lose. And never invest in something you do not fully understand. That is the reality of China's chip revolution. It is reshaping the global technology landscape right now, and it will continue to create both risks and opportunities for informed investors. If you found this analysis valuable, hit that subscribe button. I break down complex market developments into actionable insights for beginner investors. Drop a comment below with your thoughts on the US-China tech competition, and I will see you in the next video.